But if we had had an investor, they would have had very little idea of what the best priority was in a given week. It's been a different story in the venture capital industry. Deep tech was less in vogue than it is right now. If you're sort of investing in what everyone is excited about at any given time, you may not be early to the next great thing.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing from their emerging manager perspective. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm honored to have Andrew Rubenstein as our guest. He is a venture partner at Shorewind Capital. Andrew, thanks for joining us.
Thanks for having me.
Andrew, can you please share your path to venture capital?
Yeah, so like you, I'm a JD MBA. As I was finishing up grad school, I knew I wanted to go into investing eventually. Always loved investing, different types of investing. I was obsessed with stocks in high school, stuff like that. Took the bar, but decided to go work for an early stage company. Joined there as the second employee, ran business development. Learned a lot about startup life and felt like I could pass along some of those learnings to founders. I figured at some point in my career I would end up doing some sort of venture investing. Didn't know how early stage, but since I'd been at a small company, thought there was some wisdom I could be able to share to founders as they are going along that journey. So in 2021, helped co-found Shorewind Capital.
The career paths that we have are very different yet similar in the sense of, as you mentioned, JD MBA, but my first job out of grad school was biz dev.
Yeah.
And I think that biz dev role is such a jack of all trades role. It's a little bit of sales. It can be like all sales.
Yeah.
It can be purely strategic partnerships.
Yep.
It can be marketing. What was your biz dev role like?
It was a lot of sales and some partnerships. So basically, I went and worked for a direct-to-consumer company, and I was hired to build out the wholesale channel. So they were trying to make more of a push into B2B. They were doing some B2B sort of through like mom and pop shops, and mostly Fair, like through Fair. And so my job was to help build out sort of bigger B2B relationships. So it was a lot of sales. So I was calling up kind of like larger companies that had sort of just bigger points of distribution for us and trying to build a relationship with them over time so they would, buy a couple sets of our products and see how those sold, and then we could eventually do a larger wholesale order. So it was a lot of sales, but marketing was definitely a big part of that because I think marketing, figuring out how we could market ourselves as a business overall to potential wholesale partners was very important. And I basically did. It was a small team. I was the second employee. There were basically 3 full-time employees, including the founder. And I basically did everything that came up that didn't include software engineering. So I learned a lot about how dynamic those environments are, how nimble you have to be as a small team to tackle different things. One of my learnings was like if we had an investor, this was mostly a bootstrap company by the founder, but if we had had an investor, they would have had very little idea of what the best priority was in a given week. Because we would go in on Monday, I would go in on Monday thinking this is what I need to tackle this week. By Wednesday, it was a totally different set of priorities. So that's a mentality I've taken to venture, which is like, we're here to help founders, and we do it a lot through biz dev and trying to open doors. But I'm not going to come in over the top on a Tuesday afternoon and be like, hey, how's the marketing spend? What are you guys doing this week? Like, that's just not, I think we don't have enough visibility into how they should be spending their time. We generally defer to founders on that.
In 2021, you helped start Shorewind Capital. That's also when I started Context Ventures.
Yeah.
2021 feels, in retrospect, like one of the best times to start a fund.
Yeah.
Maybe 2020 beats it by a little bit.
Yeah.
But I think now we're in 2025, and I think a lot of emerging managers are in like survival mode.
Mm-hmm.
How have you and the Shorewind Capital navigated the past 4 years?
Yeah, definitely. I mean, as I mentioned, I knew I wanted to go into venture probably at some point in my career, and it seemed like a good time in 2021. That was the zip code you wanted to move into at that time. I think there's probably a lot of people at startups that maybe want to get into venture at some point that are looking at jumping into venture right now or trying to and are saying, I might wait a couple years. So it's crazy how quickly things can change. Yeah, I mean, I think every year we've been around, the last 4 years, it's been a different story in the venture capital industry. 2021 obviously was very frothy. 2022 was sort of this transition year where like experienced people were sort of like, hey, there's going to be a downturn, like things are going to get tough for startups. 2023 I think was like the sort of realization of that, and then now is this. There's still a lot of quiet pain happening, I think, still from the hangover of 2020 and 2021, but there's a ton of excitement around AI. So my takeaway from all that is just every year there's a different game on the field and different sort of moods in the industry, and it's hard to predict what's going to happen. You kind of just have to stay nimble.
For sure. JD MBA, I did it out of not knowing what I wanted to do. Yep. Curious why you did it, and also which aspects helped you as a venture capitalist?
Yeah, so similar. I did not know what I wanted to do out of college. I went to law school, so once I applied over to the business school after 1L. So I started just in law school. I think business school, when I first started in startups or venture, business school, I think just helped me kind of speak the language a little bit more and feel more comfortable. But honestly, in venture, I think being a lawyer has actually, I think, really helped me as an investor, because in law school, you're trained to just figure out what the holding is. Like basically, what's the like thesis of the case that you're reading, and that's what people get cold called about. And so you sort of train your mind after a while to hone in on what's the holding, what's the one thing I need to sort of take away from this case. I think in venture, often when you're diligencing a company, you're going to have imperfect information. You're not going to be able to get all the information you want. Maybe there's a tight timeline. So often you have to sort of figure out what are the two or three most important things diligence-wise I need to focus on, and I'm probably not going to have time for the other 7 or 8 that could matter. So I think the way law school sort of trained my mind to just focus in on what's the thing that the decision is going to turn on. That's what I do when I'm looking at a company, and especially often if you only have a week or two to do the diligence.
There's a number of folks who have gotten a law degree that are fantastic investors. I'm thinking Peter Thiel, David Hornick, Scott Cooper, Miriam Rivera. So I do agree that the law degree can be helpful. Can you share what Shorewind Capital invests in?
Yeah, so we invest pre-seed through Series A, mostly at the seed stage. And say the simplest way to describe the sectors that we spend most of our time in are health and climate. And climate is sort of a loaded word as like an investment thesis right now, and I'm happy to get into that. On the health side, we tend to invest sort of at the intersection of the trends around consumer health and longevity and the traditional healthcare system. We look for companies that can sort of have success in both worlds. And then on the climate side, I mean, energy, agriculture, things like that. But we have a flexible mandate, so we do opportunistically invest outside of those areas. Deep tech more broadly, I would say probably half the portfolio across both of our funds now is hardware. Out of our new fund, we made 3 investments. 2 out of 3 are hardware companies. So I would say health and climate is sort of the simplest way to describe it, but at the same time, it doesn't fully capture what we do.
Why is climate such a hot button issue right now?
So I mean, basically certain parts of the IRA are being rolled back, and climate went from being a pretty hot area, no pun intended, in 2020, 2021, to now one that I think folks are sort of moving away from because the expectation is that there's going to be less government support. Ironically, what we've seen is that the data center build out in AI is actually creating a lot of demand for energy companies. Whether a lot of the innovation that's happened around renewables is going to help that build out happen. So although climate is maybe not as popular of a category as it was a couple years ago, there is actually a lot of demand for a lot of those startups. We're so excited about it. We just, I think it's just a certain subset of companies that have a major tailwind right now. But yeah, for us, it doesn't change that much. Our thesis in climate was always to focus on companies that are commercializing products with green discounts instead of green premiums. So really no companies in our portfolio now have any sort of additional headwinds because of there being less government support. These were always products that sort of made sense from a market perspective anyway.
At Context Ventures, we do pre-seed, but we hardly touch hardware just because we tend to think it's really hard for a small, early emerging manager fund to go do deep tech hardware. Yeah. How do you all square that circle?
Yeah, so I mean, I have the least amount of sort of engineering expertise on the team. So one of my partners, he started 2 consumer hardware companies and then switched over to deep tech investing afterwards. My other partner has been doing deep tech investing for like 10 plus years now, so they have a good amount of expertise in it. I think hardware is often rightfully labeled, hardware is hard. That's a thing you hear often in venture. It definitely is hard, but when companies get to the other side of that, I think they have a little bit more defensibility. So that's one of the reasons we like it. We also think that when you can commercialize sort of breakthrough hardware products, the size of the outcome can be much bigger. So there's more sort of financing and engineering risk up front, but the reward for overcoming that risk is greater than what you might find with a typical software company. But it's all risk-reward trade-offs, and so we're comfortable with that trade-off, and we understand people that aren't as comfortable with it.
I mean, right now there are, I think, some of the hottest startups are hardware: Anduril, Castilian, Shield AI.
Yeah, when we started in 2021, deep tech was less in vogue than it is right now. So it's great to see that. I mean, there's more downstream capital for these deep tech companies. There's also more competition kind of at the earlier stages. I think the industry has sort of adjusted by saying, for a lot of these companies, instead of it being like, let's do a $2 million pre-seed and then a $5 million seed, a lot of these deep tech companies just raise like $20 million off the bat, which creates a question for us: do we still want to invest in a company we're super excited about if it's a much higher valuation? That's some of the strategy we're navigating at the moment. But overall, I think it's great that there's just more capital available for those kinds of startups.
At Shorewind, one of your missions is moving humanity forward. And I'm curious, how do you balance that with strong returns? And I think it's fair to say that you can do both, but I'm curious how you all think about it.
Yeah, it just goes back to outcome size. Like when we started in 2021, a lot of what we saw on the software side were like vertical software applications. And our strategy as a fund, we're not leading deals. So we're not getting 10% of a startup or something like that. Our strategy is to be a follow-on investor. So we're going to own 3, 4, 5% at entry. And with that in mind, we realized we had to underwrite to much bigger outcomes. And what we saw when we looked at the landscape of startups, the ones that we thought could have the biggest outcomes tended to be deep tech companies. There's definitely a lot more risk up front in terms of can they build it? Can they raise enough money to figure out if they can build it? But for the ones that made it through to the other side, we thought the outcomes could be bigger. There are definitely examples, like you can find large outcome sizes in software as well. We find a lot of those companies sort of fall into the category of how do you pick the winners. And so that's, we struggle to get conviction. But again, I think it comes down to the fact that we're not leading deals. We're following, we're operating as a follow-on check. So, we're more sort of price takers than price makers.
Family office dynamics. You've described them as playing a significant, often behind-the-scenes role in tech industry and VC. Can you talk more about the role of family offices?
Yeah. So I mean, family offices, are LPs in a lot of, both the sort of marquee venture funds and emerging venture funds. I think a trend lately has been that a lot of family offices want to go direct. Whereas maybe before they would invest in a venture fund and then invest like in SPVs that the venture fund would offer into their portfolio companies. Family offices now, I think, are trying to figure out how they can get directly on cap tables and have their own sort of sourcing motions as well. So there's definitely a little bit of a changing landscape, but they play a big role as LPs and then sometimes as investors directly in the startups as well.
There's a line within the venture world that is, if you've met one family office, you've just met that one because they're all so idiosyncratic. Yeah. Thoughts on that?
Yeah, it's definitely true. I mean, a lot of family offices, I think, there is the mandates are evolving in real time. If you think about how family offices get created, it's often, one family member, has a big sort of, exit or something like that. And suddenly the family is trying to figure out, okay, we have X amount of money to manage. Some of it's going to go into public markets, some into private equity, some into venture. And, there are professionals that will come in and sort of advise on that. But often families are sort of figuring out the strategy in real time. And it can change it can lead to shifting strategies and things like that. But it's, I think that's a good way to describe it. Yeah, because a lot of the family offices, I think, there's just different preferences and risk tolerances and things like that.
When I meet a family office, after the pleasantries are done, I quickly have to decipher, are you doing venture or not?
Yeah.
Will you do venture? And if you do venture, how much? And if you have done venture, how much? And so there's so much of like, it's just not standard.
It's not standard, and I think there's a bit of, I think some family offices, not all, but some have a little bit of fatigue from, let's say, the downturn in 2022, where not as many distributions were made as they would have hoped, and so they see there's this big disparity between TVPI and DPI, and there's maybe a little bit of venture fatigue amongst certain family offices. And then, yeah, at the same time, I think some will not want to necessarily be upfront about that because they still want to sort of present that they're open for business. And if you were gonna bring in the next Google or Facebook, they would want you to call them. So they don't want to say nope, we're not doing any of that stuff. They sort of just try to toe a certain line.
Totally. You referenced Tailwind previously a few minutes ago, but you also have a Tailwind podcast.
Yeah.
Can you talk more about what the Tailwind podcast covers?
As I mentioned, so both my partners have been doing deep tech investing for a long time. I have no engineering background. I was a history major and then went to law school. So I realized as we saw there being a bit of a white space around deep tech a couple years ago, I needed to really understand the science and engineering behind a lot of these products. So I just started reading a ton of books about science and tech and business. And eventually, of course, we're in venture and there's sort of a promotional aspect and marketing aspect to running a venture fund. So I thought, okay, well, I'm reading all these books. Maybe I could get the authors to come on and talk about them, and then we can publish those episodes. So that's what Tailwind is. I interview authors of books I've read about science and tech and business. Started it last summer. We're about to release our 16th episode, and it's been fun. It's a good excuse to read more. I love asking these authors follow-up questions about some of the stuff they wrote in their books. And I like to think it's helping get the Shorewind name out there. As you and I just talked about offline, I need to start doing video and stuff like that. And so that's on the roadmap for it. But that's how Tailwind started.
I'm sure it also feels very intellectually stimulating and engaging, just to sometimes be able to apply stuff you learn from books to the industry.
Yeah, 100%. I mean, I think that was before I started reading or focusing my reading on these types of books, I was learning a lot just through diligence. And I realized that I just was not able to connect the dots that well between one company we saw and another company we saw, even if they were kind of in the same category. I felt like I was sort of learning about individual trees instead of like the larger forests. So it's been really helpful just on the diligence front, on the screening front, just to be able to ask the right questions on like an intro call, or even just to look through a pitch deck before a call and know what questions to ask. Although it's ironically, had I waited a couple years, I probably could have just used ChatGPT for all that stuff. But I'm happy I still went on that journey.
In terms of Shorewind, I'm curious, what are some of the companies you're most excited about? And it doesn't have to be by revenue, but just by like what they're pursuing.
The companies that, there's sort of two categories. I would say the deep tech companies, most of which are pre-revenue and are still working to sort of cross off like technical and engineering milestones. And then the ones that are not necessarily deep tech and are like truly in market generating revenue. The ones that I would say are just kind of advancing with speed, like they're crossing off their technical milestones really quickly. Those are the ones you tend to get the most excited about. And then on the non-deep tech side, certainly, yeah, scaling revenue is important, but also seeing them get like big hiring wins and things like that, like hiring people out of larger incumbents that they're competing against. Yeah, I don't know. We've made 29 investments. It's interesting. Like 4 years in now, it's still hard to predict. I would say which of the 29. If I had to try to place 5 into the sort of upper tier of like these are the most likely to be like ultra successful, it changes. It changes, every with the quarterly updates. Like it's my sense is startups are like things are generally not going as well as they should be, and then you get a big win. And everyone, there's a lot of momentum, everyone gets excited and everyone's super motivated. And then from that big win, things are not quite going as well as they should be, and then another big win. And so the successes are lumpy. Yeah, it's interesting to track them all. Because I was working at a CPG company prior to this. I mean, had a tech back end, but I've definitely learned how different categories of companies have very different arcs in terms of trying to scale.
There's this evolutionary biologist, I think he phrased the term punctuated equilibrium or evolution.
Yeah.
And I feel like that's a fair bit of how startups are.
100%. Yeah. I think it's a roller coaster. Obviously, like when you're in the company, I don't know how founders, they must, I guess, adjust after a while to being able to like sleep well at night, because it's got to be so stressful. Whenever there's constantly fires to be put out, and it's a hard job.
Being an emerging manager is, in my opinion, not as difficult as being a founder, but still also being a founder.
Yep.
What are the analogies you would make between emerging managers and startup founders?
There's definitely still stress. It's sort of longer term stress. The feedback loop is much, much longer. So with a startup, you might fail fast. As an emerging manager, you might fail pretty slowly. I think that failure as an emerging manager is going to be a little bit quieter. It's just sort of like a slow fizzle over like many years. But I think there's definitely still stress. Most of the time, as an emerging manager, you're getting bad news from companies, because even if you're super successful as a venture investor, 80% of the investments you make aren't probably going to work or lead to the types of outcomes that you're targeting. So it's a lot of bad news that's coming in, or at least news that's not as good as you would hope for. But I think you sort of learn to live with that, and try to just focus on being long term.
I say founders and emerging managers need to be vaccinated against rejection.
Yeah.
And I feel like so much of the news is also, you need to be vaccinated against bad news. Even when I opened the San Francisco Chronicle, it's just like so much bad news.
Yeah.
But yet, still humanity is progressing.
You almost have to sort of disassociate yourself from the present, both with the types of investments you're making. Because if you're sort of investing in what everyone is excited about in any given time, you may not be early to the next great thing. It can still work if you get into a great hot company and stuff like that. But yeah, it's such a long-term job. You really have to try to force yourself to not chase sort of short-term things. And it's tricky. Yeah, there's a lot of noise, especially when you live in Silicon Valley like we do.
You're involved with Investors Table community.
Yeah.
That's actually how we met.
Yeah.
Ilya Strebulev came and gave a talk.
Yeah.
Can you talk about how it started and how it's going?
Yeah, so it's funny. I mean, we had no intention for this to like scale into anything like it has. It started basically right after COVID, when things were opening back up. People were, getting dinner in their homes again. We decided we were all sort of, Shorewind had just started. Dave Anderson and Beat Ventures had just started, and Sam was, I think, itching to go back into social VC dinners and things like that. We basically decided let's just host some dinners at our homes, just 10 VC friends, and like kind of catch up after we had all been just kind of like working from home, sitting on Zoom for 2 years. And yeah, it just kind of blossomed into this thing. I think after like a year and a half of just doing these dinners at homes, which went from like 5 people to 10 to 30. We decided to go sort of scale it up and like get sponsors and do it at like larger venues. So now we get maybe 50 to 75 people to come to these quarterly events, and it's just pure networking, hanging out. We've done some programming, like as you mentioned, but for the most part, I think it's really just supposed to be something that it's like a pretty non-transactional environment where people can pop in for half an hour, catch up with their friends in the industry, and leave if they have to go home. And I think people like that atmosphere about it. So yeah, we do these quarterly events. It tends to be mostly emerging managers, and we just expanded to New York. There's like a New York version. They did one, and I think they're planning to do another. So it's funny. Yeah, we really had no intention of making this into something, and then of course it turns into something which is kind of just it's how life works sometimes.
It's how startups work.
Yeah, totally.
And it's great because emerging managers, VCs, also need community. There's tons of community for founders. There's less, in my opinion, for VCs because it's very much you're on your own.
Yeah. I mean, for us, because we mostly follow on into deals that are being led by other VCs, having relationships with other VCs is huge for us. I mean, it's our source of deal flow. So we always, I mean, I probably spend just as much time talking to other VCs as I do with founders. So it's always been a big point of emphasis for us at Shorewind, but we know for firms that lead deal, it's different. Yeah, so I don't know, but that's always been a big sort of emphasis for us, is just trying to build out and manage the network of other VCs that invest in companies like us.
If 2021 was a great time to do and start venture, 2025, tough, hard, but actually in the future could look good.
Could.
I'm curious what your forecast is for 4 years from now, 2029.
As far as when I look at the data, a good vintage is made up of, let's say, attractive sort of valuations at entry, but I think more importantly, frothy valuations at exit. So yeah, I think one could argue maybe outside of AI, because there's still this sort of ZIRP hangover, entry prices are relatively fair at the moment as far as like seed stage valuations, and even in AI, there's some of that too. But you really just, I think what really matters the most is what the timeline looks like when these companies are exiting and how long it takes for them to exit. It's a different game now. Like in the 90s, companies would raise money and go public like 3 years later. Like Amazon and Apple, I think IPO'd after 3 years because just there wasn't this big sort of growth capital ecosystem sitting there to keep companies capitalized. So the exits came faster, and so now it's different. My sense is over the long term, and I think this will start to materialize over the next 4 years, a lot of VC exit dollars will come from selling secondaries rather than IPOs and acquisitions. Those will still be a part of it. I think right now, I would imagine secondaries are probably hold the lowest proportion of those three, or at least historically they have. I could see it flipping, especially as some of these sort of multi-stage firms continue to grow. Growth stage firms continue to grow. There's a whole new host of like secondaries firms that have spun up. All those investors are going to have to put their money somewhere, and so I think it's probably, I would imagine that they will be buying out shares from seed investors, and that's just going to become much more part of the ecosystem, like it evolved that way in private equity too. I mean, I think private equity firms, when they, it used to be you would take a company private or you would sell it to a strategic. Now private equity firms just flip companies to each other back and forth, basically. And so I could see venture evolving in that same way.
What criteria or aspects make a startup really attractive to Shorewind?
So I would say on the founder side, the simplest way to describe what we look for, I'd say, are technical founders who can sell. And that doesn't mean that they necessarily need to be like great salespeople overall, but just kind of in their market with the types of people and stakeholders they're interacting with, they need to be great at sort of communicating a compelling vision. And it can definitely differ based off of the type of market that they're operating in. So yeah, I'd say on the founder side, technical founders who can sell. We generally look for some sort of tech advantage that's clear early on. Over long periods of time, a breakthrough technology gets commoditized, but we look at sort of a technology advantage in the early days as a way to build other moats over time. So it's sort of just like a head start. Yeah, and then I think some the more sort of upfront risk around engineering and the more capital that has to be raised, the larger the size of the potential outcome has to be. That's a big thing. Nuclear fusion would be like the perfect example of that. Like, tons of risk up front. You got to raise a lot of money. It's still unproven, but if it works, the outcome would be very big. So yeah, the sort of the right balance between the sort of risk and reward in terms of the kind of upfront risks and the size of the potential outcome if it works.
What advice do you give to founders? Like, what's your go-to advice that you share with your founders?
Yeah, so I think that particularly on the deep tech side, when thinking through the sequence of fundraisers and milestones, making sure that there's not a mismatch between when a fundraise has to happen, typically because runway is sort of running short, there not being a major milestone that was just crossed. So like the best time to go raise a new round is after some big value inflection point, which on the deep tech side could be some sort of engineering breakthrough or some proof that the prototype works or something like that. Sometimes I think just because of like runway issues and maybe things took longer than they expected, founders have to go raise a new round when there hasn't been that sort of value inflection point. And so I think building in the buffer into your roadmap to make sure that you don't have to go raise until there's really something that helps make the pitch much more compelling. I think the same general principle applies to non-deep tech companies, but it's going to be based more off of revenue and number of customers and things like that. But I think just really being intentional around sequencing the sort of the targeted milestones and when to go raise, and then trying to build in as much buffer as you can, so you're not having to go back out to market when there isn't something that is so compelling. It sounds easy to say that, and like obviously startups are very dynamic and pivots happen and things like that, but that's something I really try to work with founders, is just coming up with a good plan on that front. But again, it's easier said than done.
If I had to synthesize what you just said, I feel like a lot of it is you help founders backwards plan, and then from there do sequencing of actions.
Yeah, I think especially for first-time founders, they could use some additional perspective on just how VCs think, especially VCs at different stages. Seed stage investors think differently from Series A and Series B, and for folks that haven't navigated that before or haven't spent time in VC themselves, it's helpful to hear some of the inside baseball and how those downstream decisions get made.
So often when our pre-seed founders go raise a seed round, we tell them, think less about what the investors will think and purely focus on creating customer value. Because so often we find that some of our pre-seed founders are just like, how will the seed investors think about it? And we're just like, if you create customer value, they will understand that.
Yeah, I think that's definitely true. I think we don't do that much pre-seed investing. I think, to your point though, I think seed stage investors are not often thinking, they're not sort of dissecting revenue growth and user growth and things like that. Like they're mostly investing off of vision and team and things like that. So I agree at that stage. It's more like sort of Series A, Series B is I think where investors can start to scrutinize some of the more like measurables a little bit more. And that's what we try to help inform them about. And it definitely, unfortunately for founders, like those thresholds and those standards change. They've changed so much in the 4 years that both of our firms have been around. So we warn founders about that. But I agree. I mean, I think ultimately if you're focused a lot on the customer and a lot of the sort of success metrics will fall into place. But yeah, a lot of my scar tissue on this front, I think, comes from the world of deep tech, and so we try to help founders navigate that.
In deep tech, within what we do or what we see with military veterans, they're doing a lot with dual use and defense tech.
Yeah.
And so much of their success is underpinned by how much SBIR dollars, government dollars, IDIQs. How much is that in the spaces that you play?
Often early on, particularly deep tech startups, like they'll get some government funding, to help. This could be even before like they spin out. Like this could be even when like the team is still at a university lab, and they get some government dollars. It could be right after they spin out. So it definitely helps. We tell them, I've seen companies that get too reliant on grant funding in between rounds, to the point where they can delay the next round for a long time. And there's pros and cons to that. Like it's obvious, like I just said, you want to go raise the next round after crossing some big milestone. So if the government dollars are helping you do that, that can be a good thing. At the same time, I think if you're not getting feedback from the market, for 3 years at a time, unless the revenue has really scaled or something like that, founders might be surprised to hear the feedback from VCs when they finally do go out to market, because the standards are constantly changing. So that would be, it's good and bad. It's a double-edged sword. I think obviously good to get the extra funding, and it's non-dilutive. But at the same time, I think you don't want to go too long without interacting with the capital markets.
We fast forward 2029 to talk about venture overall. Now let's fast forward to 2029 for Shorewind.
Yeah.
What do you hope Shorewind looks like in 2029?
We get asked this question for fundraising, and like we don't have a great answer. I think our like the main focus is just trying to make sure we invest the money we've raised right now as well as possible. think there's a number of different ways we could grow over time. As I mentioned, we're mostly a follow-on fund, so if we decide to really scale the fund, and Fund 3 and 4 are larger than our current funds, we could just take that same strategy up to the Series B and C and just be a follow-on check at those rounds, or we could try to start to lead seed rounds and Series A's and things like that. We don't quite know yet. Yeah, I think we're mostly we have a 4-year investment term for this fund, so it's going to be a while before we go back out to market, and I wouldn't be surprised if the world has changed a lot by then, and not exactly sure how, at least as far as like the venture industry and things like that. So we'll see when we get there. But yeah, it's right now I think we're mostly just focused on the investing side of it, which is often not a great answer for LPs. I think LPs want to hear that there's a very specific roadmap out there, and because understandably LPs I think typically want to find some managers they can just back at successive funds. And we definitely plan on raising more funds down the line. We just don't know exactly what strategy we're going to do it with.
I think it's fair for emerging managers to say that I'm biased because where you start off, I think of Fund 1 as pre-seed, Fund 2 as seed, Fund 3 as Series A.
Yeah.
And companies change very much between those two, and so do emerging managers.
Totally. I mean, correct me if I'm wrong, like did pre-seed rounds exist 10 years ago? Yeah, so who knows what it's going to look like in 10 years. AI could make it so much less capital needs to be raised up front, and VCs are writing much smaller checks in the early stages and then are writing huge growth checks down the line. And the game, it's crazy how much the game changes in any given year, and who knows where it's going.
Let's end on some positivity.
Yeah.
You invest with the Shorewind Capital team in health and climate primarily. What are your hopes for humanity on both those fronts?
Look, I think on the climate front, I think climate, that word, for some people implies green premium. What we see are companies that are, founders that are very aware that in order for their companies to be successful, their products really would need to make sense from a market perspective. And so, the products need to either be cheaper or better or both. Cheaper, better, faster, like that phrase. Founders are very aware of that. They're building their companies to that end. And so I think there's always going to be innovation with how energy gets converted. We convert energy from one form to another in a way that's helpful. And I think a lot of the companies we look at would make sense even if there wasn't a climate crisis going on. Like these are just energy companies. So I'm seeing things really come down the cost curve. I'm seeing really dedicated, passionate founders take a leap and start businesses in these areas. And so I think just from an energy perspective, there's going to be a lot of innovation, which is really exciting to see. On the health front, I think there's basically two trends going on, and these are sort of eternal trends. One is when people get into a state of sickness, there's technology that can bring them back to a state of wellness sooner and more effectively than before. And then obviously there's a big trend around, people want to invest time and money into when they're in a state of wellness, try to stay in that state of wellness for as long as possible and as effectively as possible. So I think you're just going to see those trends. Those are sort of like eternal trends, and that's a big reason why we invest in those areas. Like there's just eternal innovation in both health and climate or energy, and I think you're just gonna you're gonna see products get better and cheaper, and I think it's exciting times.
We're going to move into rapid fire questions
as
we close out. So I'm going to ask favorite books, and I think you're going to have a number of books that you know of, but and feel free to name several, given you run the Tailwind podcast.
Yeah, I think it's so hard to pick. So we've done 16 episodes, and I could pick books that I haven't done interviews for. But there's one I would call out. It's about ASML. It's called Focus: The ASML Way, and the author of it is this Dutch tech reporter. His name is Mark Hayink. The story of ASML is fascinating. One of the things I love about, I've sort of discovered by doing this podcast, is being in Silicon Valley. There's there's sort of a consensus way on how to build successful tech companies. Like there's definitely, people have different opinions about different nuances of it, but generally it's the same path and there's the same best practices. ASML it was this. It's a spin out from Philips. There were no really VCs involved. There was a successful entrepreneur involved. That guy sold his shares after 4 years. The initial CEO they brought in to run it, he was out after 4 years. There's been no sort of like, legendary. Like there was no like legendary co-founder CEO. The recent CTO was the first engineering hire, and so he would be the sort of like star of the story. But it's in a very sort of European way. It's not really. It's about the team, and I think that company it's incredible. It's incredible what they built. Those machines are really. They're birthed not just from ASML, but from like a whole region of like these suppliers that have spun out of Philips. It's just an incredible story, I think, about technology and sort of cross-border deals. And so I don't know. Long answer to your question, but I would shout out that book. But which, by the way, like lithography is a very complex engineering topic, and he does an amazing job through diagrams and explains it all very, very, very simply.
I believe if you want to understand semiconductors, obviously people mention TSMC, people mention NVIDIA, but ASML is so critical.
It's so critical, yeah. And these machines are incredible. I mean, they have to be flown to Taiwan on like a 747, and they're basically the size of like a semi truck, and it's just an incredible story. That company.
Favorite movies?
Oh man, that's a good question. Blood Diamond. Great movie, great acting from Leo, Jennifer Connelly, and very compelling story. And then I would say Almost Famous.
Favorite travel spots?
I've studied abroad in Spain at different points in my life, and I love Spain. Want to go spend some time back there sometime in life. I don't know when.
Favorite snacks?
Pretzels.
Pretzels you get on the airplane, or pretzels, any type of pretzels? Any pretzels?
Pretzel chips.
Cool.
Yeah.
Favorite restaurants?
Sushi Ron in Sausalito. Probably favorite sushi spot in the area.
Andrew, it's been a pleasure talking to you. Learned so much about Shorewind Capital. Wishing you and the team massive success. If you're not listening to Tailwind Podcast, you should listen to it to learn about the best books coming out. And thank you for your contributions to emerging managers to investors table community.
Of course, thanks for having me.
Thanks,
It's awesome.
Andrew.
Yeah, cheers.